Hello and welcome to Pitch the PM. My name is Doug Garber, and today we have a special guest, Hugh Anderson, who will be the host and PM, and myself, Doug Garber, I will be the analyst pitching a stock. I like to be on both sides of the table and stay fresh that way. The stock will be VSTS, Vestis Corporation. They recently spun out from Aramark 2 years ago. It's a special situation with an activist involved. It's a traditional industrial company. It's a route-based business similar to Cintas or UNF. They essentially deliver uniforms and other business services supplies to local businesses. So it's about route density and efficiency. A new CEO, Jim Barber, just started. I'm also a big fan of using AlphaSense. They have a great expert library, and they also have AI technology that allows me to get to the information a lot quicker. They have a market intelligence platform that's trusted by 75% of the world's top hedge funds and 85% of the S&P 100. They use generative technology to surface key insights instantly from over 450 million premium resources, including company filings, broker research, news, and trade journals. And with the recent acquisition of Tegas, AlphaSense now offers the world's largest expert transcript library. It's 150,000 plus proprietary interviews, and that's growing by 6,000 interviews each month. Not only do you have the library, but they'll also go find experts for you. Now, for those of you who have been with Pitch the PM for a while, you'll remember Hugh Anderson was a special guest in our apprentice program. It was our most attended apprentice program. And Hugh he's someone I looked up to when I was an analyst, and he was a PM over at SAC. And I'd go there marketing, and when I was on the sell side, and I'd see the guys in the offices and be like, that's where I want to be. He's pitched stocks, and he's been in the PM scene, had people pitch him stocks for a long time. I'll turn it over to you.
Thanks, Doug. And, thanks for letting me be your stunt PM. It's a privilege, really. My background, I was PM at Stadia Capital for 5 years, and then at SAC Capital for 6 years. And then I ran a long-short equity book at Lombard Odier for another 3 or 4 years. So always in energy and electricity and alternative energy and that kind of stuff. But recently I founded the Independent Center for Analyst Development. ICAD is a one-on-one analyst training program that is modular, and there are about 20 modules, and it covers everything from, advanced valuation to forecasting to cyclical assignments to fundamental analysis to macro analysis to industry analysis, management motivation. So every aspect of what someone needs to do the job is part of this program. And we train, existing analysts. We train people that are in the industry that want to transition to be an analyst. And we also train college students, and it's international as well. So we're training a student in Hong Kong. We have a student in Austria. We have a student in the UK. We have lots in New York, Florida. So it's really satisfying, and we've had some great results. We've had recently a couple analysts that have transitioned into full-time roles. So it's fantastic. So here I am. Pitch me this thing.
That's great. And for all the people who reach out to me asking to kind of review a case study or for a little extra tutoring, I refer them to you. At the end of the day, you really want to be trained by a few different people before you mold into your own process. So I still learn from you in our conversations.
What action do I want the portfolio manager to take?
We should go long VSTS. I think the company sandbagged the guidance on the last call. They essentially pulled the full year guide and sandbagged the Q3 guide to be flat with the Q2 guide, even though the business was actually getting better. Now, this was a somewhat new CFO who did this. And she's just getting her reporting up to speed and getting her internal metrics. The CEO at the time, the call was led by the chairman, essentially. He was a former president and COO of Cintas, who's a bellwether in the space. The CEO wasn't in place yet. They had fired the current CEO. The company had missed the earnings by 25, 30%. The revisions came down. The stock came down with it, as it should. and they got rid of the CEO. They've now announced a new CEO coming in, the former COO of UPS, Jim Barber. And the interesting thing is when you read the 8K of his compensation agreement, his stock priced 2 days after the earnings call. Now, this might be standard operating procedure. I don't really know when. He didn't join the company till the end of the month or the beginning of June, but the stock price 2 days after the missed on the quarter, the eliminated dividend, they breached a covenant with their lender, and they stopped talking about free cash flow guidance for the year, and they pulled the full year guide. Just kind of a lack of credibility. And so I think people have kind of painted the business as, hey, it's a broken business. This can take a lot to fix. Whereas what I'm seeing is a little bit of a road bump in something in the old CEO put in place in terms of the credit she gave to customers for retention. Now, it's a good time to say, I do own shares, but this is non-investment advice. It might not be suitable for you. And you should check with your financial advisor to see, this is a small cap company, highly levered, and the management is unproven. Now, overall, I would say this is a good business. It's not a great business like software or something like that, but it is a good business, pretty recurring business as well. And you've seen some people like Cintas who run the business much more efficiently, more density, better technology, more products going through the same routes. It's essentially a delivery business. That's why it makes sense to bring in someone from UPS. They're essentially much higher margins. They're a compounder. They're a huge success story. And the chairman of the board for Vestis is actually the former president and COO from Cintas.
Do you understand this business?
Yeah. So this is in my wheelhouse. I ran an industrial portfolio at Millennium. And then when I was at Citadel, part of my book was industrial as well. This is also a relatively simple business to understand. It's essentially supplying uniforms and business supplies, mats, other things, first aid kits, et cetera, to local businesses. So, you've got plants to wash the uniforms, and then you've got customers, and you just got to kind of organize your route so it's efficient and provide good quality service and communicate, have the right inventory. So it's a simple business to understand. I also have been following this company specifically for a couple of years since they've really spun out from Aramark. And this is a business that even Buffett bought as well. He bought a uniform business as well. I don't think it was one of his 20 best of all time investments, but it is a simple business that to understand. And, I think he probably bought it 7-8 times. The disclosures, he bought it in the mid 80s. The disclosures about specific businesses kind of trailed off. So again, if you're trying to follow Buffett's footsteps, I think it's an understandable business. It makes money. And, but again, my call here is more about the quarter being a variant view on a sandbag guidance, and based on last quarter, pulling the guidance and just mismanaging the business, it being a speed bump and not a broken business. Long term, I think when you buy a business, there's really two things you're buying. You're buying a balance sheet and a management team. And here, this balance sheet is not good, and the management team is unproven. Now, this should be a pretty stable, growing business, but it's a fixer-upper. They need to improve their density, and they need to manage it better. So there's a lot of potential here. There's also a lot of leverage. But for me, this is the variant view specifically is around the quarter.
Is the stock available at a reasonable price today? Yeah,
they're trading about 8 times. UNF, one of their comps that's privately owned, is about 8.5. And then Cintas is at 29 times EBITDA. Now that's a large cap that runs much
so
it
can do no wrong. It trades inside the 10-year.
Yeah, it is a large, yeah. It's been a great compounder. UNF is at 8.3 and Vestis is at 8 times. So if they get the growth going, the multiple could go a little higher. It's not an unreasonable number, but essentially this is a pretty classic story where you need earnings revisions to drive the stock. The bet is not around a different multiple. The bet's around earnings revisions. Now, there are some other important things here when you look at EBITDA, because they have a lot of interest expense and they also have finance leases below the free cash line. So you really got to go through every line item on the free cash, on the cash flow statement here. You got to have it fully built out.
I mean, it sounds like we've talked about why it's mispriced, and that we'll sort of come back to that. But what's the variant view versus the street then?
The variant view, and you heard this on the last conference call, is that people just think it's a broken company and it's mismanaged, and they weren't invested in when they were part of Aramark for a couple of years, and they've just got a lot of structural problems. Whereas my view is this is a speed bump. And what happened is when they spun out of Aramark, there was another activist, Mantle Ridge, who was on the board, who kind of caused that spin out. And when they gave their initial guide, their long-term guidance was like 4%. The economy was booming, and they were kind of pressured, right? Then Mantle Ridge, you spun it out, they get the equity, and then they pieced out. But now their management stuck with this long-term guide of 4% that I call it the Mantle Ridge board approved. All right, well, fast forward to a few quarters later, they're like, actually, growth's only going to be about 1%. That was last May. They guided down. And the long-term growth of this business is 1 or 2%, right? A little bit of pricing and such. It's a steady business. And then, so the CEO at the time was, all right, well, Kimberly, she decided to push price, right? And what happened is they lost customers because of that. And then she's like, all right, we're losing customers. Let's give them credits, retention credits, right? To make sure they stay. Well, credit is you can use it in X amount of time. Don't leave if we have bad service or something. Let's focus on retention. The customers would stay, but all of a sudden you lose revenue because they can use those credits when things aren't great. And you've changed the incentive of your sales force from revenue to retention. And I think that's what played out here is they talk about credits a lot on the last call. And that's not something historically they've talked about, Cintas, UNF, that they've really talked about in the past. So my view is essentially that they gave all these credits. And if you look at the decrementals last quarter, it was like almost 100%, right? Because how do you really get that? It is a high fixed cost business. But on top of that, if people are exercising these credits, that's how you kind of lose revenue. And they talk a lot about the credits, but they also talk about how the existing customers spent, I don't know, was it $8 million less than before. So I think that's kind of it. I don't view it as a broken company. I view it as this credit issue was a misaligned incentive.
Yes, tactical error. So when you're sort of looking at the evidence of how this variant view can play out, what are you looking at?
Well, I'm looking at the consensus number here is flat EBITDA quarter over quarter. First, their fiscal and calendar quarters are off by one quarter, but
I know it's annoying.
So just so when people are listening and trying to reconcile it, essentially they guided EBITDA for the quarter flat, at least flat. And I don't see how that's possible because, in Q4 they did 685, then last quarter they did 665. And then I think when the revenue comes back, it's going to have incremental margin associated with it. So I think they're going to beat Q3 because I don't know the pace of which these credits come back, but the guidance for the revenue, the street's at 674, 9 million higher. I don't see how EBITDA is not meaningfully higher than the 63 in Q3. Now, of course, the debate is, do these credits all get used last quarter or some of them still there? There's two other things that they said in the last call. The setup for this name really, for me, started on the last call. If you're listening to the last call, you'll notice not only the credits, but they talk about their overall wins versus losses. Now, they had given guidance that the amount of business they win, they're usually losing 7 or 8% of their business every year. The amount that they win from new sales processes in the field would offset the losses. And they didn't get there quite by Q2. They're a little bit later, but they're pretty close. So that's kind of the organic churn. So that's one thing that's coming back to normal. But here's the real caveat. They said by April on the call their weekly sales were the same as December. They already said we're back to this level. That means revenue should be pretty close to the 685-ish from Q4. The street's 10 million below it. So I think the Q3 EBITDA, I feel very confident that should be a beat. The question becomes twofold. One, does that translate to higher revisions for Q4 and ultimately for next year's EBITDA? Because the real thing that's going to drive the stock is, this next 12-month EBITDA of 278. Right, that's the number that needs to come up for the stock to work. And I think the flow through from Q3 to Q4, what do they even say? Do they give a Q4 guide? I'm not expecting them to give, to still a new CEO. So they might give a beat, little bit of a raise, maybe not. So that the real key isn't do they beat Q3, it's how do they guide Q4? And I don't have a crystal ball to know how they're going to guide. A lot of times companies don't know how they're going to guide until they've seen July and then they figured out on the August call. But I think Q3 should be good, and that should lead to a more likely than not chance that Q4 in the next 12-month year EBITDA has some tailwinds. They also kind of talked about other things on the call that they're not really seeing per se, like overall weakness in the industry. They're like, well, it could be out there. We're not really seeing it. Their peers aren't seeing it, but they kind of said they threw it in there.
Yeah, well, I mean, Cintas reported a week and a half ago, and they did great. So they didn't. I mean, there was nothing in the Cintas call that would indicate that there was anything sector-wise that was of concern. Although I do have a question about that.
Yeah, so I mean, just for the overall industry, I did a quick search on AlphaSense, this is my go-to expert network, and it kind of also populated like, all right, Cintas 15% share, Vestis 5, UNF 5. So it kind of gave me a quick little overview. So that was there isn't really signs in the field of industry weakness, even though they called it out on the last call as something that's good. And it comes back to, all right, new CFO. This was the old CEO's guidance. This was, the CFO's been in the seat a couple quarters, just getting the reporting going. New CEO's shares happened to vest 2 days after the call. Was it what I call a fumble rooski, or was this standard operating procedure? It's hard for me to tell, but he was getting an X dollars awarded, not a set number of shares. So, the worse it is, the more shares he gets. It might be a little welcome present for Mr. Jim Barber. Of course, that's speculation. I don't actually know. It just seems like we call it a kitchen sink quarter or a fumble rooski quarter. And there's also some studies out there when you have a new CEO that stocks do get a little bit of a bump when they lay out their plan. Now, there's no reason for me to I don't actually know if he's going to lay out his plan this quarter, wait to evaluate, lay it out in the future. I don't actually know what he said. I've not spoken to him. I had previously spoken to the IR team in the past. And so, that's kind of the variant view. I think it also, the other important thing is cash, right? Since they are highly levered and everything, comes down to kind of free cash yield. The important thing is going to be just their ability to say, hey, we're going to generate 60, 80 million of free cash on an ongoing basis. And a lot of that's working cap. So they had invested in more inventory and stuff to meet customers' needs in the first half, and that kind of drained working capital a little more than they thought, and then they pulled the guide. So you got to kind of keep your eyes on working cap, and this is kind of like a yellow light going off in my head. Anytime you have to go deep into working capital, you're like, all right, it's a little bit of a tight call here. Maybe I shouldn't be playing, right? So it kind of comes down to, could the CEO come in and sandbag and say, all right, I want to completely clear the deck? CFO didn't do enough last time, because Jim Barber was not involved last quarter, right? He wasn't in the company until June. So essentially, it's a call on incentives. It's a call on these credits, and it's a sandbag quarter. And a more likely than not chance that earnings revisions flow through from Q3. And then you have the added tailwind of sometimes a new management team lays out a plan that's positive. And I think people are just fed up with this thing. It's had since they spun out, they've had two major downward revisions to guidance. And they've lost credibility with the street. They might have set expectations too high because they had a activist involved when they spun out. So now it's a new CEO, it's a turnaround, and highly levered. They have, they just cut their dividend. The other longer term thing is if you're coming in as the CEO here, this is more on the other side of the bet, or the risk is, does he come in and say, hey, for this thing really to work, we need to invest to look more like Cintas. We need more systems, more inventory, and, have the cash flow to make this thing what it can be in terms of investing to add, fire extinguisher and other things on the trucks and other technologies and systems. That's kind of a risk. Like, he's coming in with a blank piece of paper and saying, hey, what do I need to make this thing great? He came out of retirement from UPS to do this. So it's hard to gauge what he's going to.
See, I'm going to give you my 2 cents. So you want to? I'm going to banter with you a little bit. So, I think the first thing is let's just sort of zoom out here and split it into 2 pieces, right? So you've got the company piece and you've got the stock piece, right? As you've sort of pointed out, I mean, there's only so many factors that matter here. Number one is route density. I mean, they're just heroically behind everybody else in terms of route density. So that's the obvious reason that you would hire the chief operating officer of UPS, because there's a company that truly understands route density. Number 2 would be adds over stops, which is, fundamental to making the route density have the operating leverage that you want it to. And then third would be direct sales, which I thought was kind of, direct sales is higher margin, but apparently it has a sort of seasonal aspect to it. So I mean, my response is to say, from a company standpoint, and I'll sort of throw this back to you, taking off your analyst hat for a second and looking at this company as something that is truly underperforming. And it looks to me like, especially based on Cintas, like a lot of this stuff is self-inflicted. I get that they've gotten revenue back up to December levels, but I was just checking the transcript. They said that April was at December levels. So, there is the potential that May and June didn't stay there. But regardless, let's just say it did. The problem that I have is, first of all, on that point that you just talked about, free cash flow, I would just throw that out the window, because you're looking at a company that calendar year to date, has spent twice as much on interest expense as it has on CapEx, right? So I actually have a different take. If they came out and they said, you're not going to see any free cash flow for, 6 months, because what this company needs is to improve its route density, and here's how we're going to do it. I actually think that is more compelling. Again, really from the standpoint of Vestis as a company, right? It's broken. Like, you don't go off the cliff like that, where you've got, they had a huge bad debt expense. They lost a national account. They spent many minutes on the call talking about culture. That's usually telling you something, and that the new vice president of sales is going to fix that. Like, this company's not executing. This goes way further, I think. I think it could be a speed bump in that sense, but it's neither here nor there, because they've got a new CEO, which is awesome. So it really comes down to, and we'll get to the stock part about, obviously they can make the $63 million in EBITDA, quarter to quarter. I mean, even the analysts know that, right? Because the low on the EBITDA range is 63. So, I mean, I think that everybody has internalized the idea that they can make flat EBITDA. But yeah, I mean, it should be like they should beat, right? I mean, and I think that's sort of baked in. But I'm just talking about the operations of the company in general, right? What I would expect, and I would not see it as a negative if they said, forget free cash flow. We have underinvested in this company for too long. We're doing this. I mean, they wouldn't phrase it like this, but we're doing free cash flow yield because you told us that was a good thing, even though what it meant was that we completely underinvested in the business and now we suck, right? That's actually what happened. They were trying to satisfy too many metrics. And in the process, they didn't do any of them well. So start at the top line, right? Start with route density. That's where they should focus, right? Which is classic management behavior. No, I mean, they clearly are behind because when you look at this, the Cintas margins are insane.
Yeah. So I think I'll break it down like the comparison versus Cintas, which is where, or even UNF, where they should be getting towards from a kind of holistic company perspective. First, this company trades at 0.3 times EV to sales. UNF 1.2, Cintas almost 8 times. Definitely not efficient and well run. Cintas, their biggest, there's a little bit of a product difference too, right? They have fire protection. Now I'm looking at, I did this study on Dutada. They kind of gave me a quick graph, which is awesome. It's one of my favorite kind of quick AI summary things. So their fire protection is high margin, and then they also don't do as much first aid and safety. They're more into the linens and uniforms. So it's product mix, which is density of what's on the truck, and then it's the route density. So it's both. It's two of those things that help. And they don't, to add the other product lines, you need new ERP, new inventory. They don't have the capital for
inventory, right? Yeah, I mean,
so
right.
That's
yeah, I was going to say, like, just spend your CapEx on fixing your route density, and then get back to me on the other stuff. Is what I would say, and obviously drops versus adds is crucial.
Yeah, I think that'll be a key KPI if they can report that that's finally neutralized and it's not a drag. That'll be a good thing. And then, like you said, getting that ahead, more adds than drops to improve the density. That'll be a big step.
There's really nothing they can do about. I mean, they said on the call, there's nothing they can do about their cost structure from an SG&A standpoint, and they're not going to be paying down debt anytime soon, obviously. So that fixed portion of interest expense plus, and I'm going to bring interest expense above the line just because it's just a deadweight loss, right? I know it goes below the line, you got a tax effect, whatever, but from the standpoint of how you're actually spending your cash flow, I mean, it's number one, right? Try not paying the bank and see how it goes. Oh, wait, they had to get a covenant waiver, right? So that fixed component means that your operating leverage is going to be very, very high. And what's the best way to fix your operating leverage? Get your route density up. So then the other question I had, and then we'll talk about the stock itself. This is something kind of sector wide, and it might not matter, but I'm assuming that all these uniforms are made in China or Vietnam, or because they mentioned that they bought a bunch of inventory ahead of tariffs, and I'm just sort of wondering how, for a company like this is the type of company that could come out and be like, oh, and by the way, our uniform prices are going up. Didn't see that coming, so it'll be another couple of quarters before we can repair such and such. I don't know. Again, it sounds like they bought their inventory ahead of everything, so there won't be anything on that point. And it doesn't sound like the analyst.
As the analyst, I would need to look into that more. What percent they buy from where? For some reason, in my mind, I think Mexico, but it's also they sell some, but it's also more about the the upkeep of the current uniforms for the team that's working. Sales are a little bit of it, but it's more about washing, laundering, bringing back mats, first aid kits, that sort of stuff. But yeah, the sales and the inflation there is something to watch.
It's just something to monitor. I think we have this pretty well dialed, right? So, the EBITDA estimate is $63 million. So, got it. So it's all about the guide. So I'm looking at the high consensus. So the average is 72 million. Is that what you have? I'm going off Bloomberg.
I got 70. I'm using Street Account FactSet. So we can use 72. It's that's fine.
So that's 14% sequential.
Yeah, and I think a lot of it's going to draw off, I think, the current quarter that, if you beat it's not really going to be 14% sequential if you're higher than that.
Right. It could be 12. I got you. But
even less. I mean, I think it'll be less than that sequentially when you actually see what the actual number is. So it's the last data point's kind of your data point to run through your model. And the question is the magnitude and then their outlook. So, it comes down to the three parts of the earnings that I come to is the setup. The setup is actually really good because the stock's on its butt. It's underperformed XLE by 45%. So the setup's good. Expectations are low. Not on everyone's radar. It's below $1 billion. This isn't kind of a crowd.
That was going to be my next point. It's like, I think that, so this short interest let's see, the percentage short is, call it 10%.
Yeah. The short interest has been going up. So that's actually usually a sign that the shorts they kind of know something. They know there's something wrong here and they're increasing. So usually I don't like to fight. Like usually that tells you smart money's done a lot of work and they see something wrong here and they want to continue to short it. But it's not, I don't really see BK as a risk. Like the covenant waiver, fine. Does the CEO come in and clean the deck again? He could, but the high short interest, I would not be short this thing given the low guide, the low stock performance, and the high short interest. It actually is encouraging to me to see that high of a short interest.
No, there's always going to be more money in going from awful to very bad than there is going from like good to better.
And the numbers, I feel the second part of it is always the numbers, and I feel pretty good, very good about the Q3 number. Then the debate is how much of a follow through do you get to the next quarter and the next year on the EBITDA revision? Should be some, but it's hard to know until you're there. But I would take the over on that, given the setup. And then the third part's the outlook. And do they come out? New CEO come out waiting for he didn't get the CEO job at UPS, and UPS was a chronic overspender on CapEx and such. So does he come out and say, we're going to fix this? Here are my goals, or does he wait a quarter? I don't know, but that's kind of the key. But you have a lot of other factors in your favor in terms of the setup, positive bias on the numbers, and then the outlook. I don't think he has anything to gain from pounding his chest about long-term targets or quantifying it. But I just think the setup is so good. And then you have numbers. You kind of already have 2 out of 3 to bet on. And the risk is he wipes the deck, clears the deck a little bit more. Or the company is completely broken and these credits get worse or something. But again, we heard on the call, April already back to December levels. Wins versus losses on the customer adds versus deletions are kind of almost at parity. And so I think this is a bet I would take the over on in the near term for sure. Call it like gun to head. How do you bet? This one I would call 65, 70% conviction that this, if you have to make 30, 40 bets a quarter, which is what I used to do, this one's definitely a buy for me and something I'd be added into, especially the more I look at that setup, right? Because the setup that's kind of the X factor here is like the numbers, we all have a view. We always think about the quarter, the revisions are what matters. And then, oh, wow, this setup's really good. No one has any expectations. In fact, they're betting against it.
Realistically, coming into being longest into the print, I would say that the way it's going to work is short covering. right? I mean, there's like 20 people sitting around being like, oh, I just can't wait to hear what's going on at that linen rental business, right? So I can get long. I mean, it's going to be that the second derivative of change angles, in a way that shows that you've hit some sort of trough here. So I mean, and if you don't have that, then shorts don't work, and so then you have to cover and you move on, you move to the next person. So that's fine.
Well, that's interesting because that's actually very powerful to me when you're bringing it up because the most aggressive buyers are short covers. And I used to say one of the best pieces of advice I gave actually to a healthcare PM was just in passing. It was like, a bad short is a great long. And like, oh, that makes a lot of sense.
Yeah, I may or may not have that happen in reverse a couple of times.
What's the short thesis? The short thesis is that the company's completely broken, the credits get worse, and the CEO comes in, raises CapEx a lot, and wants to lower the bar so his expectations are better. There's a chance he does that. I don't know what he's going to do. I haven't spoken to him. But if that's it's good to know what they're playing for.
Well, all right, here's two things to consider, right? So this is a stock that has a vol of 102.
When you see the vol, you're talking about IDEO vol?
No, I'm just talking about let me see what I used. It's 90-day volatility, okay, is 102. All right, so that means that on any given day, the stock could move 5%, and that would be normal.
Oh, yeah.
Okay, so we're already dealing with something. I mean, you go into a print with a company that's bigger than $1 billion of market cap, and if you had a 5% move on the print, that would actually be a lot. Here, the 5% move just on any random day is normal for this stock. So where I'm going with that is, what I'm saying is that if you come in and you're long on the print, like I said, I mean, the reason this stock is going to work on the print is short covering. And so, what you have to think about is what would satisfy, and in order for the stock to go down to satisfy a pre-existing short, someone has to sell it on that day, right? So then that's either going to be someone adding to their short, or I just can't believe that there would be that many longs left to sell, right? The guy Corvex, he just keeps buying it. He's got a massive position, and his assets under management are like $2 billion. So anyway, my point is just to say that, like, look, there's no one in that top stack of HGS that's going to sell, right? The number one guys on the board, sellers, because the holdings are so concentrated in people who are long this name and are in it for a turnaround. So the only people that are going to be selling on the print are new short sellers. And I haven't looked at what the borrow rate is, but you'd have to, I mean, if you're coming in short, in order to make this work, you're going to actually have to short even more. And you might not be willing to put that capital into place. So I think the setup is pretty good from that standpoint. Myself, I actually think that the best sort of short breaker or long attractor in terms of what the CEO says or does, this company has a 60% debt. Like I mean, first of all, I don't even know how they spent all that.
Well, they spun with it.
They spun. Okay. Oh, right. Here you go.
And a dividend. Yeah, exactly.
They borrow our debt. Have fun. So anyway,
the folks at Mantle Ridge, that was their.
Yeah. Hey, thanks, pal. I get it now. And of course, they justified it. JP justifies it because, it's a rental business, a contract business. So then, therefore, that, makes sense to have all this debt attached to it. I get it.
They had 4 or 5% top line growth, and that all flows through. So, the EBITDA, they've missed the numbers. That leverage was based on EBITDA that was far higher.
Right.
So EBITDA to go down again.
Right. So, my point is just that new CEO needs to come in and say, look, we need to significantly improve our execution on route density. We need to significantly improve our ads over stops. And, that's going to be my main focus. This is what I did. I don't know, maybe go into, where he sees the potential. And then, frankly, I would hope that he would say something like, and therefore we are going to invest in systems to make this happen. Because as I said to you, this is a company that year to date has spent twice as much on its interest expense than it has on CapEx. And if you keep doing that, you won't have a company. So they have to change. They have to change. And the other thing, too, is they just have to reset the expectations. This free cash flow stuff, that's not what is going to actually lead to a revision in how the equity market prices this equity capital. It's going to come from fixing your operations. So I wouldn't take it as a negative if he came in and he's like, free cash flow, forget it. It's not happening for 6 months. We need to invest in this company. We need to improve our route density. We need to improve our ads over stops. And here's how we're going to get there. So as long as he says something like that, then the stock will work.
Yeah. So, it's, at the end of the day, it comes down to the qualitative or conviction. How many times have you, all right, when, last time you met with them, how did you feel after that meeting, right? What was the CEO's, what was his tone? Did he feel confident? Like so much of it, all right, you got to make a call on the quarter and you met with this guy 2 months ago and you're like, how do I feel about it? How's the stock moved? And it's like, it's your gut feeling about how you read his body language. And that's what it comes down to. So it's going to be about, how does this guy, what's his presentation? What's he bringing to the table? And is he ready? He's probably not going to quantify it and get ready to give numbers yet. But if he comes in with conviction of, they did some low-hanging fruit stuff on equipping their sales force, and they did start to put some of these things in motion. But it's clear they need to do a lot more. And I think not having the free cash and putting that back into the business, does he say, hey, we need to get to look like Cintas, we need to invest in these other systems to get more into fire protection and that? There's also some M&A you can do. And the other angle here, they don't have that much capital for M&A, but to get into that fire protection business, you would probably need that. Now, there's a huge, the other angle here is they have a 2-year anniversary of when they spun from Aramark. That tax implications for anyone who looked at it, and that expires in October. So that means they would be in play, essentially more in play for a takeout without negative tax consequences. And if you look at there's been a lot of there's been a lot of speculation and there's been some activity on the M&A front, right? Because they obviously, like you mentioned, their balance sheet's not great. They need to fix things up. It's hard to do publicly.
Cintas, why would you want to assume all that debt? I can't imagine that the tax.
You think 4 turns of debt's a lot? Private equity would call a lot 6 times.
No, I know, but I'm just saying. Even
it's the revenue. If they can run it better, right? You're trading at 0.3 times revenue. Cintas is 0.8. UNF is 1.3. They even had interest from a French company. They've had interest from private equity, and this is all public record.
So I believe you. And then actually, if you wanted to go on that spin, on sort of level of spin, then you could say, well, if interest rates come, because I think their bank debt is floating, right? I think it's indexed to, it's indexed to CME. So if interest rates come down, then their interest could bend a little bit.
I try not to.
I would prefer for them to fix the company.
I don't invest on, hey, this company's going to be bought or a takeout, because you never know when or if, and that can't be your whole thesis. And they have a new CEO, so he probably wants to put his mark, fix it up. But I would say, yes, there's this tax thing in October. I wouldn't necessarily expect there is potential for someone else to fix it up better, but I don't think he's going to come in and just do it. So the new CEO change kicks the can on a potential. They want to fix it before they sell it. No one wants to sell down here. They want to fix it up and sell it back for, mid-teens, $20 or something. But there is interest. So that's kind of gives me a better feeling about, hey, if they mess up even more, there is interest in the asset.
Yeah, I believe that. I mean, they have 3,500 customers, and I mean, they have established routes. So
I can't figure out what the shorts are thinking here, because this is an M&A candidate. Like, numbers are most likely sandbagged. They're just thinking, hey, highly levered company, broken operations. When I'm saying, yes, highly levered operations were more of a speed bump than broken. I guess that's my variant view, is I'm calling it a speed bump, not broken. And the leverage to say it's serious. So the way I think about it, like, if you have a $10 million position, you're going to have $4 or $5 million at risk on the print. So you're going to have, if you want to have, how much money are you willing to bet? If you're willing to risk $2 million of your risk allocation, then maybe your position's only 5 million, right? Because that's how I would think about it, right? If you're, only going to risk 1.5 million, then your position's 3 million. So it's a very high vol name. I think a lot of the larger pods are probably saying this is too small, too volatile. I'd rather bet, 50 million on, Caterpillar or Deere, 3 or 4%, right? So the same amount of risk, but they're able to deploy more capital with lower volatility. So they're going to be deploying 50 million on CAT and say, all right, if that moves 3%, I can make the same 1 million, but my vol metrics will be better. So it's kind of below the radar of most of, I would say, the pod shops below $1 billion. You could do it. It's doable. But it's more of a special sit. You have the activists. You just got to mess. You got to mess with the debt, the new CEO, the pulled guidance, and the poor operations. So that's,
what's not to like?
Well, what's not? Yeah,
No, I'm kidding. I'm giving you a hard time.
Low bar, and I think the shorts are probably
that's for sure. Yeah.
But I'm biased. You shouldn't listen to me because I already own it. So I'm talking. You got to know everyone's bias before they get involved. That's always so important. Like, what's people's history in it, and that kind of dictates how they think about it and pitch it. But yeah, like I said, if I was in my old seat doing 30, 40 pitches a quarter, I would definitely take the over on this one. What would you do? You?
The reason I would long it into the print is what I said. Number one, my experience has always been that new management gets the benefit of the doubt, and they should. In this case, like I said, fix your operations, right? Route density. The chief operating officer of UPS is presumably going to know how to do that, right? So, so that's number one. So you have, short covering from sort of a stock positioning standpoint. My hope is that the CEO invests in the company. I'm fine with free cash flow. I mean, free cash flow yield at Cintas is remarkable, which is why they trade inside the 10-year. I mean, that stock is trading so rich. It's crazy. The long is benefit of the doubt for the CEO, who hopefully talks about improving operations and investing capital into the business. Short covering. And then I suppose that the sequential guide matters, but I would argue that I don't think it matters quite as much. I think the CEO would do well to kind of get rid of sort of the manic, obsessive focus quarterly print stuff, and really try and orient people on margin improvement. Stock's been demolished for good reason. So, and I said, like, there's more money in going from awful to very bad than there is in going from good to better. I mean, I'd pair it against Cintas and just see what happens.
Yeah, it definitely can do that. You'll definitely have some size exposure and leverage exposure and factor.
Yeah, I mean, you normalize it. Obviously, you can figure out vol to vol how to get it to be a 1-to-1 pair.
All right. Well, thank you very much for joining us, and look forward to future conversations about other stocks. I definitely feel a lot clearer now about the the setup being better with the short interest and, CEO does come out and say, we got to spend more to win. I think that could work.
That's a good thing. Yeah.
Good. Well, thank you. Thank you for taking the time to come on, and always a pleasure to chat with you.
Likewise. Appreciate it.
All right. Bye.
All right. Bye-bye.
Please make sure to follow Pitch to PM on your favorite podcast app and never miss out on episodes. This show is for entertainment purposes only. Please consult a professional before making any decisions. This show is copyrighted by Pitch to PM. Written permission must be granted before rebroadcasting.